Welcome back to the Deep Dive, the shortcut to being truly well-informed, where we take complex financial, technological, and behavioral research and distill it down to the essential high-impact insights you need. Today, we are diving deep into a company that has somehow managed to embed itself into the daily routine of millions. I mean, it's a genuine cultural phenomenon. We're talking about Duolingo, ticker DUOL, and of course that iconic green owl that terrorizes you with notifications if you even think about missing your lesson.
It's true. That owl has some serious passive-aggressive energy.
It really does. But let's look at the numbers. Financially, we are assessing a massive valuation. As of our data snapshot on January 12th, 2026, Duolingo is trading around $164 per share.
Which gives it a market capitalization soaring past $8.2 billion.
$8.2 billion. And here's the central challenge, the real why of this deep dive for you today. On the surface, Duolingo is, by almost any measure, a phenomenal growth story.
Absolutely. It has industry-leading retention metrics that, frankly, put most social media apps to shame.
And it has successfully married this addictive gamification with, real-world utility. But success, as we know, always comes with a price tag. And that price tag is a normalized forward price-to-earnings ratio that's hovering around 54 times.
54. That's a steep number.
It is. So our mission today for you, the learner, is to figure out what you're really paying for. Are you paying for a permanent, impenetrable, data-driven software fortress that's going to justify decades of high growth? Or are we simply paying an enormous premium for a highly engineered behavioral loop?
A loop that might be masking an underlying weakness, something we're calling the illusion of competence.
Exactly. Is the game truly worth the price? We are going to find out.
That is absolutely the right way to frame it, because a 54 times normalized earnings multiple, that is demanding the kind of perfect execution usually reserved for, blue chip monopolists.
Zero room for error.
None. The market is pricing in zero room for error, both on the product side and, importantly, on the financial side. Before we really dissect the structural defenses of this business, though, a quick important note for those of you who find investment ideas inspired by our discussions.
Right. If you are looking for the platform to execute on these ideas, we personally use and recommend Interactive Brokers. You can use the special affiliate link we've provided for you down in the description right now.
And that link provides a great benefit for you. You get a stock bonus when you sign up and fund your account. And it's also a fantastic way to support the ongoing research and the deep dives we do for you every single week.
And while you are checking out those details, please do take just a quick second to hit the like button, subscribe if you haven't already, and share your questions or your specific thoughts about Duolingo in the comments section below. We absolutely read them all. Your engagement genuinely dictates the direction of our future deep dives.
Okay, now let's pivot our focus back entirely to Duolingo. To understand if that valuation is even remotely justified, we have to start at the foundation. We need to look at the core business engine, how it makes its money, and the structural defenses, the economic moats that are supposed to protect that cash flow stream.
Let's do it.
When you peel back the layers of Duolingo's revenue structure, you immediately see it's probably the highest quality version of the freemium model out there. I like to call it a black box of monetization.
A black box? What do you mean by that?
Well, they strategically give away the core product, that vast array of language lessons, for free. But they monetize heavily by creating friction points and then selling you the solution to that friction. It's a brilliant setup.
Okay, let's clarify that revenue mix because this is crucial. The vast majority of their high-margin revenue, we're talking about 75% to 80%, comes from subscriptions.
That's Super Duolingo or the new Max tier.
Right. Ads are only about 10% of revenue, and the rest is from things like their English proficiency tests. So the primary purpose of the free version isn't really to maximize ad views.
Not at all.
It's to act as the most effective, highest quality lead generation tool on the planet.
That's precisely right. The free product isn't some separate lower quality business line. It is the top of the funnel. So you have users paying anywhere from, say, $80 to $120 per year, primarily for one of two things.
Okay, what are they?
First, to remove annoyances. You pay to get rid of the limited hearts that punish you for making mistakes, and you pay to get rid of the repetitive ads. So you're effectively paying to remove the friction they intentionally placed in your learning path.
Which is genius.
Yeah.
And the second reason?
The second is for genuine feature enhancements. This is especially true in the newer, higher-priced Max tier, which incorporates really advanced AI-powered features like personalized role-play conversations.
And the introduction of that Max tier is a genuine litmus test for their market power, isn't it? I mean, we see so many companies try to raise prices and they face instant, massive pushback.
They do.
But Duolingo proved they have genuine pricing power. They successfully launched a premium tier above their existing standard price point, and people paid for it.
It's a really powerful demonstration. And you can see the results clearly in their average revenue per user, or ARPU.
Mhm.
We've seen ARPU increase by approximately 7% year over year in recent quarters.
And that's not just from them cranking up the price on everyone.
No, and that's the key point, that
Yeah.
growth is not primarily coming from just hiking the price on Super Duolingo for everybody. It's coming from a change in the user. Mixed shift users are voluntarily choosing those more expensive, feature-rich tiers, especially Max.
They're upgrading themselves.
They are. And this brings us to a concept that I think is fundamental to the stickiness of the brand. It's this idea of effective balance.
Okay, explain that for us, because it sounds a little bit like academic jargon, but you're saying it's critical to understanding their subscription model.
It is, absolutely. Think about a standard necessary subscription you have, maybe your cell phone bill
Yeah.
or your internet service. You probably hate paying it. You might even dread that monthly charge.
For sure.
The effective valence there is negative. You pay purely for the utility.
Mhm.
Duolingo is the exact opposite. Users willingly upgrade. They often boast about their streaks and the progress they've made, even if that progress is, kind of marginal.
Right, they feel good about the purchase.
They feel good about supporting the product because the product makes them feel good about themselves. They perceive paying that premium cost as reinforcing their identity as a learner, as someone who is improving themselves. This strong, positive, affective valence means the churn rate is naturally lower, and it gives them the power to charge more for that emotional reinforcement.
So, okay, we have a high-quality product that users feel genuinely good about paying for. But how defensible is all of this? If the unit economics are working this well, what stops Google or, I don't know, some massive competitor from simply cloning the green owl? This is where the Moat assessment comes in, and at 54x PE, we need to see a fortress.
And the primary defense is subtle, but it's incredibly powerful. It's structural counterpositioning. This is a classic textbook example of the innovator's dilemma.
Okay, give us the contrast. What position did Duolingo take that inherently repels the big established incumbents?
Okay, so think back a decade ago. Think about the traditional EdTech incumbents. Rosetta Stone is the classic example, or maybe some of those large corporate language training providers.
I remember those yellow boxes in the airport.
Exactly. Their business model was high margin, low volume. They charged high, often multi-$100 upfront fees. Their entire marketing premise was serious education requires a serious investment. Their margins were beautiful, but their user base was tiny compared to the total global population of language learners.
They were selling a luxury good, essentially.
In a way, yes. Duolingo's foundational strategic move was to flip that script completely. Their mantra, which really remains true today, was game first, education second. They offered the core learning experience entirely for free, supported only by, small ads initially. They went for volume and engagement first and decided to figure out monetization later.
And I see the structural conflict now. A traditional incumbent like Rosetta Stone, even if they recognize Duolingo's dominance and wild success, they can't simply adopt that free, game-first, volume-based model because they would be committing immediate business suicide. They'd instantly cannibalize their existing, highly profitable, high upfront fee revenue stream.
Exactly. The cost of switching strategies for them is financially devastating. It's just not a trade-off they can make. And that structural inability to copy the model without destroying their current cash cow creates this powerful non-technological barrier to entry. This counterpositioning is arguably their strongest defense because it's not based on IP or some temporary patent. It's based on an economic trade-off their competitors simply can't afford to make.
That makes sense. But beyond that strategic defense, there's also the secondary and I think increasingly vital moat that's built on data scale.
Yeah.
That's a huge component of the bull thesis, especially now with the rise of machine learning and AI.
Oh, this is where the long-term potential truly resides. You have to understand the scale here. Duolingo currently has approximately 50 million daily active users, DAUs.
50 million every day.
It's an unprecedented scale in education. And those 50 million people are collectively completing literally billions of exercises, responses, and mistakes every single day.
So what does that get them?
It gives them a unique, proprietary, and absolutely massive data set on human learning curves. They know, better than any academic institution or any competitor on the planet, precisely where Spanish speakers struggle with French grammar. or how Italian learners respond to different reinforcement schedules, or which teaching modality maximizes retention for beginners trying to learn Japanese.
So that feedback loop has to be exponential then. More users generate more data,
Which allows the AI to personalize the instruction better,
which drives higher retention and stickiness.
which in turn generates even more data. It's a virtuous circle. This data is the engine behind the company's ability to constantly update its curriculum and its AI-powered features. For instance, if the data shows that, say, 80% of native English speakers fail a certain passive voice lesson in Portuguese, the AI doesn't just grade the mistake.
Right, it learns from it.
It learns, and it updates the learning path for every single future user, perhaps introducing micro-lessons on that specific concept much earlier in the curriculum flow. This constantly rising data moat makes it almost impossible for a newcomer to catch up without somehow matching the data volume of a global social network.
Okay, but we have to address the anti-moat check here. With the explosion in accessibility of generic large language models, LLMs like GPT series, basic language tutoring is now effectively a commodity. It's available for free or very low cost instantly. Doesn't that just strip away Duolingo's entire utility?
It's a great question, and it's probably the biggest bear case on the technology side. And yes, it commoditizes the raw utility. If all you want is a list of verb conjugations or a quick translation, an LLM is fantastic. It's probably better.
So what's the defense?
Duolingo's defense is that its core utility is not information transfer. It is habit formation.
Oh.
The critical defense is that gamification wrapper. The streaks, the competitive leaderboards, the little treasure chests, the push notifications that leverage shame or the fear of loss. That entire behavioral loop is what shields them from the raw utility of a simple chatbot. A chatbot can teach you, but it cannot make you want to log in for 500 consecutive days.
And the stickiness is the financial proof of this strategy. I mean, their daily active user to monthly active user ratio, the DAU MAU, sits at an astounding 37%. As you mentioned, typical EdTech is often below 10%. Duolingo is competing with Facebook and Instagram for daily attention, not other learning apps.
That 37% ratio is not a fluke. It's the result of carefully engineered behavioral economics, what Charlie Munger would call the Lollapalooza Effect. It's this combination of multiple psychological biases all working together to create a powerful behavioral addiction loop.
Okay, let's pull the curtain back on this. What are the specific biases they are hitting so effectively?
They are absolute masters of operant conditioning. First, they use social proof through leaderboards and friend lists. This leverages our natural, innate tendency for competition and conformity. We log in because we don't want to drop out of the Diamond League or fall behind our friend.
Right.
Second, they leverage scarcity and loss aversion through the streak mechanic and the limited hearts. The entire system is designed to make the loss of your streak feel disproportionately painful. It hurts more to lose it than it feels good to gain another day, and that forces you to log in daily, even if it's just for 5 minutes.
I can personally attest to the power of that loss aversion. I have absolutely logged in at 11:58 p.m. just to maintain a streak, even though I knew the 2 minutes of learning I was doing were completely worthless from an educational perspective. The value was purely in protecting the metric.
That is the perfect illustration. And there's a third, more subtle one. Variable rewards. The system isn't a predictable linear syllabus. You get chests, you earn gems, you get these unpredictable progression unlocks. This variability is scientifically proven to be more addictive than fixed, predictable rewards. It taps directly into the brain's dopamine-driven reward centers, making the act of logging in intrinsically motivating and, frankly, exceptionally difficult to abandon.
So it's a powerful combination, but your own anecdote leads us directly to the pre-mortem check, doesn't it? The greatest risk to the entire investment thesis.
It does. The core challenge is this. The business relies fundamentally on the feeling of progress and the dopamine reward of streak fulfillment. This feeling is measured by internal metrics, gems, points, streaks. But it may not correlate directly with the actual verified utility of achieving conversational fluency.
This is the illusion of competence risk that we really need to spend some time on. If the system is so incredibly good at reinforcing the habit of learning, does it perhaps obscure a deficiency in the outcome of learning?
It absolutely can. And this is the catastrophic scenario for the valuation. It's a large-scale collective realization by the user base that, hey, they've spent 2 years dutifully maintaining their streak, they've ascended all the leagues, they feel great about their progress, but they still can't confidently order a coffee or handle a basic job interview in that language.
A moment of truth.
Exactly.
Mhm.
If that utility gap, the gap between the effort you've expended in daily logins and the real-world result you've achieved in fluency becomes too wide, you can see a mass churn event, a behavioral correction. And that could instantly detonate this high valuation thesis. The market is currently betting that the high effective valence and the strength of the streak are sufficient forever, regardless of the ultimate educational utility.
That's a fascinating pivot point. So if we accept that this powerful behavioral engine is the primary source of the moat, we need to transition now and see how much that engineered function actually translates into hard financial results on the income statement.
All right, moving to the financials. Duolingo exhibits all the hallmarks of a truly high-quality software business. Their gross margins are high, and, importantly, they are stable. They consistently sit right around 73%.
Which tells you that the fundamental subscription model is sound. The cost of serving one more user is basically zero. They are selling knowledge, which is infinitely scalable.
Exactly. But the real story here is the operating leverage. It has been nothing short of spectacular. They haven't just had high gross margins, they've converted that into aggressive bottom-line profitability.
Right. We've seen adjusted EBITDA margins expand from, what was it, just a few years ago?
A minimal 4% just 2 fiscal years ago
Yeah.
in FY22. And now,
Yeah.
they're exceeding 25% in the last 12 months. That is textbook proof of operating leverage at work.
So what's driving that? How do you go from 4% to 25% so quickly?
This aggressive margin expansion is driven by the scaling of their R&D and general and administrative costs. Think about it. They spend huge sums developing the platform, creating the AI algorithms, building out the gamification structure, and creating new curricula for new languages.
These are essentially fixed costs.
They're largely fixed costs. So as the user base exploded from, say, 10 million DAUs to 50 million DAUs, that massive fixed R&D cost base is now spread across 5 times as many users. The cost per user drops significantly, and that's what drives that profitability from 4% to 25% plus almost automatically.
Which suggests that as they continue to add users and expand their TAM, those margins still have substantial room to run.
They do. They could possibly head toward the mid-30s over time.
Okay, but here's where listeners really need to put on their accounting goggles, because the headline PE ratio is highly deceptive. If you just glance at the trailing 12 months, the TTM PE, it appears shockingly low, somewhere around 21 times earnings. For a growth company like this, that looks cheap, and this is the shenanigan alert we need to deconstruct.
We must be crystal clear about this. Do not be fooled by that headline 21x number. It is an artifact of tax accounting, not a signal of operating brilliance. That TTMPE is artificially compressed because of a massive one-time net income spike in the third quarter of fiscal year 2025.
Okay, hold on. What exactly was the release of valuation allowance, and why did it add $292 million to net income if it wasn't operating cash flow?
This is a complex but absolutely crucial accounting concept. It relates to something called deferred tax assets. During its high-growth pre-profit years, Duolingo was losing money, which generated tax losses. They essentially got an IOU from the government. These are called deferred tax assets, or DTAs, which they could use to offset future taxes once they became profitable.
So it's like a tax credit they saved up.
A perfect way to think about it. But for years, accounting rules required them to put a valuation allowance against these DTAs. They essentially had to say, on paper, we don't know if we'll ever be profitable enough to actually use these credits. It's a conservative accounting measure.
And then they became profitable.
Consistently profitable. In Q3 2025, the company crossed a threshold where management and their auditors became confident that they would be consistently profitable going forward. So they were allowed to release this allowance. It's a non-cash bookkeeping move, but that $292 million flowed directly to the net income line, making it look like they earned massive operating profits that quarter. It's a technical correction, not money generated from selling Super Duolingo subscriptions.
So we have to strip out that distortion to understand the real operating value of the business. The true normalized forward PE, based on ongoing operational earnings forecasts for fiscal year 2026, rockets right back up to that demanding 54 times earnings.
That's the real number we have to justify. And speaking of hidden costs, we have to talk about the significant and persistent drag of stock-based compensation, or SBC. This is often the cost that high-growth technology companies defer to their shareholders.
And for Duolingo, that cost is substantial. It's not a rounding error.
Not at all. Stock-based compensation amounted to about $120 million in fiscal year 2024. Now, when you compare that to their total revenue, it's about 16% to 17% of revenue. That is a material cost.
So while Duolingo reports these seemingly impressive free cash flow margins, often in the 25% to 28% range, the real free cash flow is actually much lower once you account for the cost of SBC.
Materially lower. This is where, for a purist, Duolingo fails the gold standard FCF conversion test. That SBC is paid for by diluting existing shareholders. It amounts to a constant annual dilution of roughly 3% of the shares outstanding.
So every year, your slice of the pie gets 3% smaller.
Exactly. If you are a skeptical, value-focused investor, you have to subtract that dilution cost from your FCF calculation to get a true owner earnings figure, and that significantly reduces your intrinsic value estimate. You're either paying a hidden tax on your equity every year, or you must treat that compensation as a true cash expense. There's no way around it.
Okay, let's move to how management is deploying the capital they do generate. When we look at a metric like return on invested capital, or ROIC, it appears optically low, which might be a concern for quality-focused investors. But this is another area where accounting can be a little misleading, correct?
That's right. The reported ROIC looks suppressed for the same reason we just discussed. The company's in a hyper-growth phase and reinvests massive sums back into R&D, lifeblood of their business. And GAAP rules require that all that R&D be expensed immediately. So the numerator in the ROIC calculation, their earnings, is temporarily reduced by this huge expense.
But the unit economics tell a different story.
The unit economics strongly suggest that the returns are actually excellent. The very high lifetime value, the LTV, of a paying subscriber relative to their low customer acquisition cost, or CAC, means that the return on incremental capital they deploy for growth, whether it's R&D or marketing, is incredibly high. They're spending money wisely to build long-term value, even if the short-term accounting metric, the ROIC, looks momentarily depressed.
So, looking at their cash deployment hierarchy, where are they strategically focusing their capital? What's priority number one?
Their primary focus is correctly on maximizing organic growth and total addressable market TAM expansion. The biggest strategic initiative by far is the push into Duolingo Math and Duolingo Music. This is absolutely the correct priority because, as we're about to discuss, the language learning market has a natural feeling. Investors rewarding them for trying to expand the very definition of who Duolingo serves.
What about M&A activity? Are they doing the common tech mistake of, buying revenue or entering completely unrelated fields? Diversification, as Lynch called it?
They've been admirably disciplined on that front. We see no evidence of large, risky diversification acquisitions. Instead, they focus on targeted, small M&A that vertically integrates their core behavioral moat. For instance, the acquisition of design and animation studios like a company called Gunner is brilliant.
Why is that so smart?
Because they're not buying content. They are buying the talent and the capability necessary to maintain and enhance the quality of that gamification wrapper, which, as we said, is their most fragile defense against obsolescence. They are controlling the source of their dopamine hack delivery system.
And finally, buybacks. Are they using any cash to address that persistent 3% SBC dilution?
Buybacks have been minimal, and that is absolutely the right approach at this moment. Given the extreme valuation that 54x normalized PE buying back shares aggressively right now would simply be destroying shareholder value, they are correctly prioritizing future growth opportunities over financial engineering at these elevated prices.
Okay, so we've established the strong notes and the high quality of the financials, even with the burdens of SBC and sky-high expectations. Now we have to tackle the core question. What are the necessary growth engines required to actually justify a 54x multiple, and what does the market implicitly demand of this business going forward?
The immediate core driver of revenue growth, the real low-hanging fruit, is increasing monetization penetration.
So converting more of their free users into paying ones?
Exactly. Despite their massive scale, only about 8.5% to 9% of their daily active user base currently converts into a paying subscriber. They have immense leverage here. They don't need to go out and find millions of brand new users. They just need to move that conversion rate from 9% to, say, 11% or 12% over the next couple of years.
And they do that by making the paid tiers more attractive.
Precisely. By constantly adding value to the paid tiers, especially the higher-priced Max tier with its exclusive AI features, and by fine-tuning the friction in the free experience. Increasing that penetration rate is the most reliable short-term driver of double-digit revenue growth.
But looking at the long-term view, even if they hit a 15% penetration rate, the language learning market is fundamentally finite, isn't it? I mean, you can't learn more than a handful of languages, and once you become fluent, you ideally churn, even if the streak keeps you addicted for a while.
That's the crux of the high valuation thesis. The current 54x multiple fundamentally relies on the successful pivot from a language app to becoming a general-purpose learning app. The market is not paying for Duolingo language. It is paying for Duolingo platform.
So the entire bull case is a bet on math and music.
It hinges on them successfully cross-selling Duolingo Math and Duolingo Music to their existing, engaged, and captive audience. If they can replicate that addictive gamification loop and achieve similar retention rates in these new verticals, they instantaneously triple their total addressable market, or TAM, and that provides the necessary runway for 2 decades of high growth that could justify the price.
I agree that the TAM expansion is absolutely essential, but this also introduces a huge amount of execution risk that the market seems to be completely ignoring. Why should we just assume that their success in language learning automatically translates to math or music?
That's the key bear case constraint. And it's a powerful one. The psychological motivation for learning a language, travel, cultural affinity, career necessity, is inherently different from the motivation for engaging with high school math problems or music notation as an adult.
Right. Who is the target audience for Duolingo Math? Is it adults needing a review? Is it students trying to supplement their homework? They face entirely different competitive environments in those spaces. Khan Academy, dedicated music tutors, you name it.
It's a crowded field. And if they fail to effectively cross-sell math and music, and the language segment's growth ceiling is hit sooner than expected, then that 54x multiple becomes instantly unsustainable. If growth decelerates from 25% down to 15% because the market refuses to adopt math and music at scale, the stock price faces a major correction because the price is built on the promise of the super app.
Okay, so let's use that reverse discounted cash flow logic to understand exactly what financial outcomes the market is currently pricing in at a 54x normalized PE. This isn't about what we think the company will do, but what they must do to earn this valuation.
A valuation north of 50 times forward earnings is, it's the literal definition of priced for perfection. It demands a clear path to both hypergrowth and eventually monopolistic margins.
What does that look like in numbers?
The implied hurdle the market is setting for Duolingo requires 2 simultaneous, incredibly demanding feats of corporate execution over the next 5 to 10 years. First, they must sustain revenue growth of 25% or more for at least 5 full years.
5 years of 25% plus growth.
At least. Second, they must achieve meaningful margin expansion. They need to push their adjusted EBITDA margins from the current mid-20s all the way up toward the 35% mark.
Why is 35% the magic number for the market?
35% is sort of the typical margin floor for established, high-quality, mission-critical SaaS companies once they've achieved scale and market dominance. Think of a mature Adobe or Salesforce. They demonstrate the power to convert high gross margins, like Duolingo 73%, into very high operating margins by leveraging those fixed costs. To earn a 54x PE, the market has to believe Duolingo will eventually achieve that same kind of structural profitability.
So, sustaining 25% growth and expanding margins by 10 percentage points simultaneously, that is an enormous ask. Does history offer any precedents for this kind of thing?
It does, but the statistical base rate for success is frighteningly low. Only a tiny fraction of companies ever sustain 20% plus revenue growth for 5 years or more. You could look at examples, maybe Netflix in its big scaling phase or early stage Adobe, where they successfully leverage their platform to enter new markets and scale margins. But these are the exceptions, not the rule. The high multiple highlights just how extreme the execution risk is. If they miss either the growth target or the margin target, the multiple will instantly compress.
Okay, since the implied expectations are so high, let's try to triangulate a fair value. We can use a few different methods to see if there is any quantitative margin of safety at a current price of around $164.
Let's do it. We'll start with method A, historical mean reversion. There's a common sense valuation anchor. It just assumes that Duolingo, while it is a high-quality asset, will eventually see its valuation multiple compress down to the average of a mature quality software peer, let's say around 40 times earnings.
Which is still a very healthy multiple.
Very healthy. So we take the consensus fiscal year 2026 earnings per share, or EPS, forecast, which is about $3.03, and we apply that more moderate 40x multiple, the estimated valuation falls somewhere between $120 and $135 per share. This suggests the stock is already trading at a significant premium to its expected mature state.
That's a huge divergence from the current price. Okay, now let's move to the most conservative method, method B, owner earnings, adjusted for SBC. This strips away all the narrative and just focuses on the true cash being generated for shareholders.
This is the skeptical's approach. We start with the free cash flow, but we adjust it for the dilutive cost of that stock-based compensation. We estimate the conservative FCF per share at around $3.50. We then project that figure grows at a still robust 20% rate for the next 10 years, and we discount it all back at a reasonable 10% rate to reflect the business risk.
And what value does that spit out?
Based on that conservative SBC-adjusted cash flow model, the resulting intrinsic value estimate sits at around $105 per share. For the true value-focused investor, this acts as a reliable floor price, and it demands a substantial margin of safety from where we are today.
And finally, Method C, the analyst consensus. This is the bull case. The view that factors in the perfect execution of the super app vision, the successful monetization of AI, and the full realization of that enormous TAM expansion.
Right. Wall Street targets are often based on this optimistic scenario. They are projecting the price range to be between $107 and $240. This is the valuation that assumes they not only hit the 25% growth targets, but potentially beat them, making the current 54x multiple feel cheap in retrospect because of rapid earnings growth.
So synthesizing this triangulation, if we focus on the lower, more conservative end, based on skeptical owner earnings and factoring in a necessary margin of safety for a growth stock, the quantitative buy zone for Duolingo would be somewhere between $105 and $125 per share.
The conclusion is pretty inescapable. At the current price of approximately $164, the stock reflects a substantial momentum premium. Investors are paying for the captivating story and the expectation of absolute perfection. For the long-term quantitative investor who is seeking a margin of safety, that margin simply does not exist at current levels.
Okay, so since the valuation demands perfection, we have to spend significant time conducting a red team challenge. What are the major catastrophic threats that could cause the market to quickly reevaluate Duolingo and erase that 54x premium overnight?
The most existential threat, the one that keeps people up at night, is technological obsolescence, driven by generative AI and platform integration.
So not just chatbots, but something deeper.
Much deeper. We talked about generic chatbots, but the true threat is when the platform owners, Apple, Google, Amazon, decide that language tutoring is a core feature of their operating system or their ecosystem. Imagine an update to iOS where Siri can engage in real-time, bidirectional, context-aware tutoring in any language using your voice and multimodal input integrated seamlessly and completely for free.
Siri, teach me Spanish.
Exactly. If that happens, Duolingo's raw utility collapses almost instantly. The user no longer needs a separate app to get basic teaching, and their only defense left is that gamification wrapper, the streak.
And that feels fragile.
That's the worry. The gamification moat is very powerful for retention, but it is ultimately a psychological defense, not a technological one. If the platform owners commoditize the core utility, hanging an $8.2 billion valuation on a behavioral loop that can potentially be replicated or even superseded by native platform features, that becomes an incredibly fragile proposition.
The second major threat is purely economic and cyclical, right? The churn cascade. The max subscription tier, which is crucial for increasing ARPU and driving that margin expansion, costs upwards of $100 a year.
That $100 plus price point is a discretionary luxury for the vast majority of users globally. Language learning, let's be honest, is often one of the first things people cut when household budgets come under pressure in a recession.
It's a nice to have, not a must have.
For most, yes. So if a significant economic downturn occurs, high churn in that paid tier could instantly destroy the favorable lifetime value to customer acquisition cost model that investors are currently betting on. If LTV falls and the paying customer base shrinks, investor confidence just evaporates overnight.
And finally, we have to reiterate the ongoing silent drag of SBC dilution. While it won't kill the company in one blow, that constant 3% annual dilution is a permanent headwind. It's a guaranteed reduction in the real returns that shareholders receive every single year. You just cannot ignore that cost.
So to synthesize our findings, we'd assign Duolingo two distinct scores. On quality, Duolingo scores very high. They have a powerful counter-positioning moat, an unparalleled data advantage, strong founder-led management, and a sticky, iconic brand.
But
on valuation, the score is unequivocally expensive. It's priced for the perfect execution of the most optimistic super app scenario possible.
okay, let's channel the most critical perspective, the red team. You gave the company a high-quality score, but how do you defend that score against the critique that the company's core driver is fundamentally a temporary dopamine hack, not durable educational utility?
That is the essential conflict in this whole thesis. The quality score is high because the behavioral moat is proven to drive stickiness and high margins, and the data moat is real and defensible. However, the red team critique is powerful, and you have to respect it. You are effectively buying a highly retention-driven gym membership business where engagement is based on psychological tricks, but you are paying a premium software multiple of 54 times earnings for it.
And that high multiple assumes guaranteed success in new, completely unverified markets, math, and music. The bear thesis would point out that there is zero historical evidence that the desire to maintain a language streak translates into the desire for an adult to maintain a daily math game streak. The high quality of the core product does not guarantee the high quality of the future market expansion.
And so the conclusion we extracted from all the data remains firm. At this price, the investor is paying a massive premium for a captivating and aspirational narrative. The story of the next great education super app, not for a verified cash flow stream that's supported by a quantitative margin of safety. You are buying the most expensive insurance policy against failure in the entire EdTech sector.
Wow.
This deep dive provides an essential lesson for every sophisticated learner out there. You must rigorously separate the quality of the product and the power of the brand from the demanding price of the stock. Duolingo is a magnificent product and a true cultural success story. No one can deny that.
But the business and the stock are two different things.
Two very different things.
Yeah.
The key insight we gain today is understanding that profound difference between the behavioral moat, that fragile addiction loop, and the durable data moat, the true long-term AI advantage.
And that separation leads us directly to the final provocative thought for you to track as you move forward. We talked at length about the risk of the illusion of competence. If Duolingo wants to truly justify and sustain a 50x plus multiple for the long term, they have to move beyond relying solely on the psychological hack of the streak.
They need to prove the outcome.
They need to prove the outcome. The ultimate signal for fundamental value creation is moving from just engagement to verified utility. So the question you need to constantly monitor is this: how is Duolingo integrating certified assessments or real-world utility tests into their platform?
That's the key.
If they start proving validated fluency, backed by accredited tests that mean something in the real world, it shifts the value proposition from a fun game to an essential career or life tool. And then maybe the valuation might be fundamentally justified. If, however, they strategically avoid verified competence in favor of just maximizing daily engagement metrics, well, it confirms that the valuation is built entirely on that behavioral loop, and the risk remains extreme.
What steps will they take to move beyond the streak and into verified competence? That's the billion-dollar question.
Until next time, keep digging, keep learning, and keep asking the tough questions. We'll see you on the next deep dive.